Right. Good morning, everyone. How are we all doing? And thank you very much for joining me this morning. Always so good to have you here. All right, so let me bring up my slide. I did not think of how to do this slide. Oh my. Okay, so let me see. Okay. I didn't realize that I'm using just one computer to do both the live stream and my slide is here. So I'm going to view and then do presentation. Dear. This is this is one of the setback of doing live stream. Okay. I need confirmation. Can somebody confirm to me if you are seeing me clearly in the live stream? Yeah, that should be okay, right? Can somebody confirm to me if you're hearing me clearly? Just in the comment. Okay. I'm going to end this live stream right now, and I think we can keep going because yeah, I should be fine. I should be fine. Okay, I should be fine. All right, wonderful. So yesterday we talked about permanent insurance, and then we talked about the fact that permanent insurance covers the risk for the entire life of the life insured. It doesn't need to be renewed, just like term insurance that needs to be renewed at the end of that particular term. And also premiums for permanent insurance are higher than that of the term insurance. And the premium remain level over the cost, of the life insured. Now, I told you that there are three types of permanent insurance. There's whole life, there's term to age 100, and there's universal life. And today we are going to be talking about whole life insurance. All right, so yes, whole life insurance is the insurance policy that covers the entire life of the life insured. In other words, as long as you keep paying your premium, your policy is in place, is in force, you don't lose coverage. Premiums remains level all through. In other words, the amount of premium you pay in your first year is the same amount you pay in your year 2, year 3, year 4, all through. Your premium doesn't increase despite the increase of your age or despite changes in your health or whatever. Nothing changes. Your premium remains the same. And also, the beautiful features about this policy is the fact that you could build cash surrender value over time in this policy. And what this means is that this policy gives you the opportunity to save, um, um, to have savings, like savings component in this policy. And the premiums are guaranteed, like I said earlier. The benefit is guaranteed. And then the amount of cash value that you have saved, the minimum amount of it, is also guaranteed. All right. That is good, and I hope this information is helping you to now start being able to see, oh, okay, so is this what I can do with whole life insurance? Yes. Now there are three different ways you can choose to pay your premiums for whole life insurance, right? You can choose to pay your premium, which is what many people default to do anyways, is to pay your premium on an ongoing basis. That is, you pay it, for your lifetime, like every month, every year, your premium, your bill comes from your insurance company, and then you pay your premiums, and then you continue like that until whenever the risk happen. All right. However, you can also choose to pay your premium as a one-time lump sum payment. That is, you pay off the policy. For instance, maybe you have a lot of cash at your disposal, or a lot of money at your disposal, and you say, you know what, I'm going to pay off this policy. The fact that you've paid it off doesn't mean that the policy is done. No, you have it, it's enforced, it's in place. It's just that you don't have to worry about paying the premium again at all for life. So that's the second way in which you can pay your premium. And then the third option that you have in paying your premium is for a certain period of time. For instance, you can choose to pay your premium in 10 years. That is, you can tell the insurance company, I want to be done paying this premium in 10 years. So the insurance company will do the math for you. Like, okay, because you'll be paying this premium in 10 years, this is how much you have to pay year one, year two, three, four, five, until year 10. And by year 10, you're done with paying your premium for your policy. However, you have that policy. Okay, you're not losing it. Then, in the same way, you can choose to pay it up in 20 years. You can choose to pay it up in 30 years, or until you turn 65, or until you retire. So for this one, I just say you do you, like whatever works for you. Just let your insurance company knows, or your advisor know what and how you want to proceed with these options, and your advisor will help you put that um, plan in place for you. Wonderful. So the next thing I want to tell you about whole life policy is the fact that whole life policy can be a participating policy, and it can be a non-participating policy. We call it par and non-par. When we say a policy is a participating policy, that means that that policy can earn you dividend. Okay, so it means that the surplus, that is accumulated through that savings component that you have. Because what the insurance company does is, you pay your premium, part of it goes towards your savings, and the insurance company invests that savings. So as that savings yield more results, and the insurance company is able to make profit, they distribute that in form of dividend, and that is distributed to the policy holders. However, this dividend is not guaranteed. It's not like your death benefit or your cash surrender, your minimum cash surrender value that is guaranteed. No, the dividend is not guaranteed. It's a function of the performance of the insurance company. And at the same time, there's what we call non-participating policy. So this non-participating policy don't participate in dividends, or when the insurance company makes profit from investing the savings, this policy doesn't participate in it, you know. And again, the premium for the participating policy is slightly higher than the premium for the non-participating policy. Again, there's a lot of information around this topic: whole life, participating policy, non-participating policy. But in this quick, daily live stream, it's difficult for me to go into detail to give you all this detailed information. But if this is of interest to you, or you currently have a whole life policy and you want me to sit down with you, over Zoom meeting, because like we don't go to people's houses now due to COVID-19, and you want me to help you review it and then see where things are for you, I'll be more than happy to do that. And if you want to take advantage of my free masterclass, so I can explain everything about protection for your family, or how you can put the right financial structures, custom made structure for yourself and for your family, feel free to reach out to me. Leave me a comment in the comment section below. And also, you can reach me on Instagram and Twitter, and also on my Facebook account where I'm streaming live from, and also my YouTube also. Okay. Again, don't forget, I am in partnership with Experia Financial Group, where we bring you holistic financial knowledge, and we do it through our free masterclass. Now, the last information around whole life policy that I want to share with you is the different types of dividend options. Now, this is only associated with participating policy. Now, if you have whole life participating policy, you have 5 different ways that you can take your dividend. Number one, you can take it in form of cash, withdraw the cash in that say. And then option two, you can use your premium to reduce, sorry, you can use your dividend to reduce your premium. In other words, you can ask the insurance company, hey, don't send out my checks for my dividend for this year, put it towards my next year premium. So that way you don't have to worry about your premium for the following year. So that is premium reduction options. And the third option is accumulation. You can accumulate, your dividend in an interest bearing account, and or you can also put it in segregated fund. But when you are taking on this approach, just bear in mind that the interest or the earning in that account is taxed annually. Okay, it's important to know that. And the fourth dividend option is paid up additional insurance. You can take up additional whole life insurance, or you can say, okay, increase my death benefit, and then you pay up that particular increment, component of that benefit addition that you have put on. So, in other words, your premium doesn't change, but you have increased your coverage. Does that make sense? If you have any questions, leave me a comment. And then the last dividend option is term insurance option. You can take your dividend and say, oh, I need term insurance for 10 years or for 5 years. Then you can use that dividend to pay up for that term insurance for the short period that you need that term insurance. And again, like both for paid up additions for the whole life, and then paid up addition for the term insurance, you don't have to do any additional medical evidence to be able to do that. So that's the beauty of this. So yeah, that is all I have for you today. Thank you so much for joining me on Instagram, Facebook, and YouTube. Again, don't forget that I am in partnership with Experia Financial Group. So if you have understanding of life insurance, or you have your life license and you're looking for a career change or a good environment that rewards your effort handsomely, yeah, talk to me because Expedia is the right place for you. So again, thank you so much for joining me this morning, and I'll see you again tomorrow morning when we will be talking about universal life. Go out there today and win. And at this point is where I say hi. Okay, I end this and that. And now, and live stream.